Hello, everyone, and welcome to the Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield, and I'll be your host today. And today I'm happy to be joined by Paul Robson, who co-heads our G10 FX strategy team for us out of London. We're going to talk today about all the major currencies today after a very pivotal week of data and events. Paul, thanks for joining.
Thanks very much, Brian. It's been a couple of weeks before until you've sort of invited me on again. So as you say, there's an awful lot to cover this week. So looking forward to running through today's ECB. We also had the UK budget, not that I think it's a major mover for the currency, and even the Swiss franc looks like it's making headlines. So thanks very much for the invitation.
Yeah, I look forward to talking about all of that. But first, I really want to start by touching on the dollar a little bit, because we've had a change in our view in terms of tactical dollar positioning. Maybe I'll run through that first and then bring you in, Paul, to talk about some of the specific currencies in your world. You sort of previewed some of the things that we'll talk about in a moment. But just starting on the dollar, those who are frequent listeners to the podcast and may have listened to our discussion last week on the dollar may remember that we were talking about this coming week of data, the week that we've had so far, as being a pretty pivotal one in terms of direction for the dollar. Thinking about the economic data in the week ahead, as this is data that's either going to sort of confirm or deny whether the January strength we've seen in economic data is something that's likely to persist or something that may be overstating. And now we are still looking ahead to a number of big data releases. We still have, as we record on Thursday morning, there's still non-farm payrolls on Friday, which, by the time you listen to this, you'll have seen that number surely. But we'll also have CPI next week. And so we still have a couple of data headwinds that we need to sort of contend with here. There's still some big event risks on the calendar. But we do think now that the picture for the US, especially from the inflation side, looks likely to improve pretty meaningfully as we get through this next couple of data points. So as we mentioned on the pod last week, we're still looking for core CPI next week to round up to a 0.4% on the month over month. That would put us slightly above the listed consensus. But after this month, we think that we're kind of come due for a string of core inflation readings that are a lot more constructive. Talking about readings closer to 0.2, 0.1% in core inflation rather than the 0.3s and 0.4s we've had over the last couple of months. And so from the perspective of inflation, we're starting to, we think that the numbers after this coming week are going to start to look a lot more constructive. So from a rates perspective, we think that the path for short-term rates in the US, which had spent a lot of the year so far rising, we think the path for higher short-term interest rates in the US is probably going to narrow from here. So from the rate side, we think that we're probably going to get less upside pressure on the dollar coming from rates. And we think in terms of economic data, the very strong numbers we've seen in January, we felt it was appropriate to lean tactically bullish as we were pricing out some of that easier Fed. From here, we think the data are probably going to look a lot more benign in terms of inflation. And so we think that the upside pressure to the dollar coming from the data side is probably going to slow. And so we're looking at tactical exposure to the downside, the bearish side, specifically long euro dollar and short dollar yen. And Paul, this is a great opportunity to bring you in to talk about some of the drivers from the Europe side. What are we thinking on the euro here? And maybe I'll first ask you about, we did have the ECB decision today as a big potential driver. What did the ECB do today and how is that affecting your thinking?
Yeah, so as you say, the event today and the important event for the euro, and I think it's going to echo into coming months, as you mentioned, upside for euro dollar is the change of call. For the ECB, to be fair, when all was said and done, I don't think it changes the outlook dramatically. There was no change in rates, but this meeting was always going to be about the forecast, update forecast to take into account recent data. And certainly the initial moves reflected that. So I always think that market pricing, market moves is a good way of looking at central bank meetings to assess what the overall takeaway was. And the initial reaction was to take euro dollar actually lower and for front end rates markets to price in a little bit more easing from the ECB during the whole of 2024. That move came on the publication of the updated forecasts. And crucially, those showed inflation at target in 2025, but importantly, in 2026 based on prevailing market interest rate futures. And if you take that all together, the ECB really should have been cutting rates today. Obviously, they didn't deliver that. But by the time we came to record this podcast, euro dollar had actually gone through the daily high. So it reversed all of that initial weakness. And that seemed to be triggered by President Lagarde's couple of comments about needing more confidence and evidence that inflation is coming down to target before they consider cutting rates. It was very similar, actually, to a number of central banks in terms of the way they are thinking about the latest data. And crucially, she said that, or we think, well, I certainly think it's important that she'll have on the General Council will have a little bit more information by the April meeting, but a lot more by the June meeting. And that seemed to be a head nod that you shouldn't really be thinking about April. June is more likely. And funny enough, that's where markets also think the Fed might go as well. So it's always one of the questions we always get is, can the ECB go ahead of the Fed? Of course they can, but they seem to not want to put too much distance at this point between the two central banks. So in the end, that was what markets were sort of pricing. And the euro obviously rallied on that, maybe covering short positions.
Yeah, I think it's interesting because I mean we've discussed, in this podcast about the potential risks around the central case for the ECB as the data sort of moving them in the direction of potentially going sooner. But Lagarde seems very confident with sticking to June as sort of the base case, and the market is kind of right there. And from a relative growth perspective, Paul, another thing I know you've been focused on is this idea of peak pessimism in Europe and peak optimism maybe in US. Can you talk a little bit about the growth side? I mean, some of the survey numbers, I think Lagarde mentioned, they have come in a little bit stronger. Inflation got revised down. How are you looking at Eurodollar maybe from a more holistic growth perspective and not just from the ECB perspective?
Yeah, I think there's a couple of things that are important. Like you say, relative growth and peakism, this idea that at some point markets will get to pricing in peak pessimism around the euro outlook, and then maybe peak optimism regarding the US. And it feels like we're closer to that point, given what markets are pricing in for growth for 2024. So I think that's important. But I think for the ECB, I think that front-end rates are now better priced at 100 basis points of easing from the ECB. And I think that means that it's going to be harder for a dovish surprise going forward and a weaker euro. And I think that provides a better base to that. In terms of peak growth, optimism in the States and pessimism in Europe, one of the things that we've noticed is that euro dollar has lagged some of its traditional drivers. So in our short-term fair value models, we've got monetary variables in there. We've got short-end rates. We've got curve slopes. But we also have how the individual bond markets in Europe are performing. Most notably, the difference between Italy and France versus Germany. And that spread between those two bond markets, free bond markets, tend to be sensitive to growth expectations, how confident people are about politics. And there's been this disconnect, and it suggests that euro dollar should already be at 113. And I think that we'll probably catch up with that. And so the forecast and expectation is continued euro strength, as you mentioned a little time ago, against the dollar.
Yeah, the fair value, certainly on our short-term fair value metrics, euro is starting to look undervalued. And another currency that is looking quite undervalued on our, and I'm sure many other short-term fair value metrics, is the yen. And that really comes down to a differential, sort of a breakdown of the relationship a little bit between relative interest rates and dollar yen. This had been a relationship that had previously been extremely close, that just charting dollar yen against a sort of a naive interest rate spread, 5-year differentials, for example, that widening of interest rate differentials in favor of the dollar as the Fed was hiking aggressively, BOJ not moving, was a very strong driver of dollar yen. And more recently, that relationship seems to have broken down a bit, where interest rates in Japan have been rising. We're at a decade high in the 2-year yield in Japan, for example, as we look ahead to the BOJ decision on March 18th, 19th. And even though US rates have fallen quite a bit really since the last time we were above 150 in dollar yen back in the autumn of last year. So dollar yen is already starting to look, it's already been looking overvalued relative to our short-term fair value metrics. And so this is another currency pair that when we're thinking about tactical bearish dollar positions, if we're starting to see maybe less upside pressure from rates, a better, more constructive inflation outlook going forward, economic surprises maybe starting to peter off a little bit after a very hot start to 2024 for US data. Dollar yen is one that I think looks particularly vulnerable for downside, especially in the near term, because we've been looking forward to this potential BOJ policy change for a long time now, and I think the market, certainly yen has been one of the worst performing currencies so far in 2024. That likely has to do with the fact that it has a very punitive carry to be long, and it's one of the more attractive funders to be short just from a carry differential. But you're now heading into a sensitive period where the BOJ has the potential to make a big hawkish change in policy at their meeting on March 18th and 19th. So I think the market, has been short yen, has sort of built up those positions over the course of January and February. Now I think we're in a position where I think the market's going to want to pare back those short positions in the run-up to this decision for March. Now, I think it's still an open question whether or not they end negative interest rate policy at the March meeting. It's a close call, I think, between March and April. But the most recent data on inflation we've gotten in Japan, both from the Tokyo CPI, the Tokyo regional CPI, and from wage inflation, which is really what the BOJ is watching, have surprised on the top side. These shunto wage rounds in Japan, the important wage negotiation period, have generally been coming in on the top side as well. We think the BOJ does have more confidence that inflation is moving up in a more sustainable way, and I think that makes the March meeting very live. So we already think that there might be some room for the dollar to fade off a bit here, to move lower just based on a more constructive inflation outlook after the March 12th reading we'll get on US CPI. But we're also heading into a period where I think the market doesn't want to be as short as it is of yen. And so I think there's a pretty good case here for dollar yen to extend lower. It's moved lower on the back of some of the stronger wage inflation data we got in Japan overnight as we record on Thursday. We think there's probably more room to the downside as the market tries to get a little closer to square ahead of the BOJ. Paul, I want to bring you back in here to talk about the UK budget. I don't think it was a huge driver for sterling, but I know fiscal policy, we are in a year, an election year, in the UK and here in the US as well. What are some of the takeaways on the UK budget? Does this have any big feed through to the currency? How are we thinking about potential fiscal stimulus and growth, and how does that feed through to your thoughts on the currency?
Yeah, so I think in terms of the budget, I don't think it's hugely important to the currency. I sort of mentioned about the ECB, sort of look at the price action around and through the event. Today was obviously the ECB and see what that means. And sterling was sort of uninterested in the end in terms of the budget. Quite a lot of the budget had actually been leaked in local newspapers, so I don't think there was a lot of surprises actually on the day. But it doesn't tend to move the needle on sentiment. It didn't really move the needle, we think, on growth and front end rates, and those tend to be the drivers of the currency. I think for sterling, it's about the Bank of England being one of the late cutters. So we still think the Bank of England goes in August, whereas we've got other central banks that are probably going a little bit earlier than that. We've talked about the Fed, we've talked about the ECB. Later on, we'll talk about the SNB, which will probably be, well, we think will be one of the leaders at the vanguard of that. But I think for the budget, and you mentioned actually fiscal policy and politics, and I'd like to file this budget under the sort of long increasing list of dogs that didn't bark around the UK outlook. We've talked a lot about bond market instability that clearly wasn't happen, or it didn't happen around the budget. We've got relative political sort of stability. I mean, we might get a change of government. Let's wait to see what happens in the general election. There's still a lot of time before that election. But generally speaking, economic policy is relatively stable. We had housing market data recently that showed real resilience in the UK housing market, residential property. And again, that's something that people have worried about UK asset-specific risks. And so this list is getting shorter by the day of things to worry about. And how does that really impact sterling? Well, it's via the risk premium. If the risk premium in UK assets is large, then people demand a lower price for those assets. If that risk premium is easing, and I think it has been and will continue to ease, then the currency can do a little bit better. And UK assets are seen to be better valued certainly by the perspective of international investors. There have been a few more stories around that in terms of the main sort of media in the UK and some on the online media. And if those assets are bought unhedged, then that supports the currency. And I think that's what you've been seeing. And I think the final takeaway for the currency is that I think sterling can participate in any dollar weakness that may or may not happen over the next 3 to 6 months. So I think the key takeaway from the budget is it wasn't impactful. And that just chips away at some of the downside risks for UK assets and supportive of the currency.
Yeah, and I know this is a position that you've held for a while, this sort of more constructive view on sterling. And this has been one of the better FX performers this year in an environment where the dollar has spent a lot of this year rising. And I think to your point, to your credit, a lot of that has been because some of these big specific UK event risks just haven't packed the same negative currency punch. I mean, we're not that far removed from a massive budget related moves in sterling. We just, we're nowhere near that level of market concern. I think that has broader positive implications for sterling, as you mentioned. You also hinted at one more central bank and one more currency I want to ask you about, which is the Swiss National Bank and the Swiss franc. This has been one that's been, we've sort of felt for a while now that FX policy, international interest rate policy in Switzerland was due for a big change. That seems to really be happening now at pace. And this is one that I think this is a theme I think the market's really catching on to. How are you feeling about Swiss franc now? I know that being short Swiss franc was one of our top calls for 2024 from our year ahead outlook release all the way back in November. Is that something you feel like is a trend that can continue? Is that a go with? How are you feeling about the Swiss franc now that we've had a solid weakening so far in 2024?
Yeah, lots of questions in that one question, Brian. So I'll try and get through the sort of multi-layer of that question, but it's a very good question. And certainly the Swiss franc was at the bottom of the weekly league table. It was underperforming. And I think the key for the Swiss franc is we expect it to continue to underperform. I think there's two drivers here of the currency. One is relative yields. We think the S&P will be one of the early easers in Europe and globally, and the major central banks of easing. But we also think the S&P is particularly sensitive around currency strength. Now, over the last couple of years or 18 months, they've been actually worried about currency weakness and importing inflation. That was fine once when all the central banks were tackling inflation shock. But now they're back to worrying about inflation coming lower. And I think that's something that the central bank will have to deal with, potentially at the March meeting, because I don't think that they can afford to hang around cutting rates when other central banks, particularly potentially, will be cutting a couple of months later. And it's that imported deflation that the central bank has to tackle. And that might mean that they cut rates fairly aggressively and earlier than other central banks. But what it might also mean is that they start rebuilding their FX reserves, something that they've been running down when they were fighting inflation. And this week's data actually highlighted that their reserves are rising again. They're selling the Swiss franc, they're buying other currencies. And we think that that's going to be a go with in your terminology. So continued underperformance of the Swiss franc. I think it will be one of the worst performing European currencies in 2024.
Yeah, to sort of add on to kind of echo that point, I mean, it's so interesting to see the Swiss National Bank in a very different position than most other central banks, where throughout a lot of the post-pandemic period, central banks worried about topside risk to inflation and were trying to actively prevent currency weakness. You certainly see that in Japan, right? We talk a lot about the potential for FX intervention to try and limit weakness in the currency. But now in Switzerland, I think you just have a different story where they are no longer actively supporting the currency because they no longer need to be fighting inflation the same way that they were. We did have the Swiss inflation number earlier this week, just 1.1% year over year on core inflation coming out of coming out of Switzerland. And so that change in tact on currency, the change in language, I think is so important as we think about the role of the currency and its role in inflation, right? When inflation risks to the top side just aren't the same, then the way the way the central bank responds to the currency can change, and that has important implications for markets. And I certainly agree with you that Swiss franc looks quite vulnerable.
There is this difference between domestically driven inflation and imported inflation, and certainly that strong domestic inflation is one pushback from our view that the Swiss franc weakens and the central bank eases early. But it's this imported deflation, which traditionally the S&P has really had a tough time fighting, and that's why they built up their FX reserves. And I think that's what the market might be missing, that it's not just about domestic inflation for the S&P. And you're exactly right that the S&P is different from a lot of central banks. Central banks aren't all born equal. And I think that this is something that markets might latch onto.
Awesome. Well, thanks very much, Paul. I believe that's all we have time for today. Thank you very much for listening, everyone. If you enjoyed this podcast, consider liking the podcast and also subscribing to our channel so that you can get our latest podcasts the moment they're released. Thank you very much.